Hello, geniuses, and welcome back to Genius Wednesday. Today is Wednesday, July 1st. It is the start of Q3, and we are heading into a US holiday week, which means that we're going to see some interesting things with the traditional markets versus the 24/7 landscape of the crypto markets. So I am joined today by our head of market research, Steve Kwan, CEO Jeremy Bourne, advisor Oz Sultan, partner JP Joff Paradise with Cryptomatic ATM. We also are joined by guest Scott Mariano and new staple to this show, Mr. Dave Weisberger of CoinRoute. So we have a full house today. Mr. Steve Kwan, would you like to start off with our market analysis for the week?
I would. I'll start with saying the markets, both crypto and I guess mature, as I'll call them, which would include commodities such as gold, crude, grains, natural, softs, equities such as NASDAQ, S&P, and Dow, have been nothing short of, I guess, impressive. Whether one thinks that it's a few people or, the vast majority, the market rebound from March 16th is, as our president has pointed out, is probably one of the most stellar in recent history. Bitcoin moving from 4,000 to 9,500, NASDAQ, Amazon all-time highs, crude oil going from negative $37, and no, you couldn't have actually bought that, to back to 40. There's a couple, I guess, main themes I would like to note. First is what I call the energy, what I call nervousness trade. And that is between Brent, which is the, I guess, benchmark for the world, versus what we call crude or WTI here in the States. And that spread has gone from, I guess, at its widest point, if you include the negative 37, I believe it was $67, but it was averaging $8 to $9 to $10 for a week or so. And now it's back inside of $2, which is more normalized. So that shows that those markets, at least on the futures front, are moving back to, I guess, more reasonable risk reward type, entry and exit points. The second major point I would mention is that the 4th of July is coming up, and that's a federal US holiday, meaning the markets will be closed on Friday and a shortened day on Thursday. And traditionally, I don't know why they still say this, because there's very few qualitative traders in the market, but whoever they are seem to take implied volatility in the option markets lower and lower and lower and lower. And the VIX, historically, 9 out of the past 10 years, has settled at a tradable low on the Thursday prior to the 4th of July. That would be in one day. So that said, if volatility is at a low point tomorrow, or at least the implied volatilities of many tradable options, something I'm looking at is having ownership of volatility. That would include Bitcoin volatility, gold volatility, and US equity volatility. One might ask, how would you, so you don't have a price opinion on all of them? No, I actually don't, but one can own volatility, i.e. you would buy options. And that's what I'm doing. I'm not proposing that someone does it. I'm simply telling you what I'm doing, and buying either calls or puts, which I've done, in equities, gold, and Bitcoin, because my analysis, as well as the CoinGenius analysis, which I actually can't show because Comcast is digging on my street, but CoinGenius research also shows that volatility has made a low over the past few years. on the Thursday prior to 4th of July. So again, if one has positions in markets, any one of the above markets, I'm thinking that I'm going to be a little bit cautious, and I'm going to have some ownership in volatility and making that bet versus a price bet for this current juncture. And we can take a look. I guess the easiest metric, if one wanted to look at a global mark of volatility, would be the S&P 500 VIX, which is traded on the CBOE and is easily looked at in SPY options or VIX or TVIX or UVIX. But I think you get the point of what I'm saying here, ladies and
And
gentlemen.
Steve, I don't know if you see that, the screen, I did share that, so you can show some of the research the team has derived from last year.
I do. I would note that it's hard for me to see it on my phone or move it around. But here's the point, guys. If you look at the bottom number, you can see the volatility dipping right into the 4th of July, and you can see right after the 4th of July, high points are being made in some of the volatility instruments. So if one would like to learn more about these reports, please visit us at the Coin Genius Discord, or you can go to coingenius.ai and message any one of us, and we would be happy to share more of this type of reports and a plethora of others done by some of the most brilliant data scientists in the world, and information and opinions gathered from some of the most influential people in crypto and mature markets. And on that note, I would pass the mic back to Jeremy and Christina.
Go ahead, Christina.
Awesome. Well, I would love to hear everyone's feedback on the roundtable. I see that Josh Lawler has joined us. I see that Morgan Steckler has joined us. You guys are more of traders than I am. So as we're looking at a US holiday, which doesn't impact the whole world, that has to be kind of treated as an event trigger. And in terms of behavior, I'd love to get your guys' thoughts. You guys have been in this race a lot longer than I have.
All bets are off is my take on it. You know, the world has not seen the type of situation that we've been in. You know, I'm still very much of an opinion, though this is not legal or finance advice, that, you know, we've got total decoupling, and it will take whatever next shoe drops to send us, you know, plunging. But, you know, that's just me. I still like metals. I do. There's an ETF that is a levered short-term VIX play, actually, that I go with, because I agree with Steve entirely that, you know, we may be setting up for a nice pump in the VIX. When I say nice, that's bad for most things, but nonetheless. And at the same time, you know, we still, from an equity perspective, NASDAQ is, you know, at an all-time high. We've never had a better quarter than we just finished. Quite honestly, it's painful sitting that out, but I largely have. And that's, you know, that's all I've got on that one.
I mean, the one thing that's interesting about the VIX is, well, there's a couple things that are interesting about it. The first, if you look exactly a month ago, looked like a reasonable tradable bottom. You know, I guess it fell below 25. And it looks like it's potentially heading that way. And I think that would be a hell of an entry point if it actually gets down to that level at some point in the next, you know, the next day and a half. The thing that's most interesting about it, and I can always remember this, is people used to be leery of holiday weekends because there's a longer period of time for something to happen in the news flow. And what matters about that is, yes, the financial markets are closed, but the reality is there's a lot that potentially could go on. I'm not saying bad things will happen. I'm not saying good things will happen, but news flow is extremely important. So I kind of hear what Steve is saying and think that the notion that something is likely to happen to, either break these the kind of doldrums that we're seeing in the market seems like the kind of bet that is a high reward, lower risk sort of bet. That said, not financial advice. I don't know if I will do anything. Buying volatility is one of those things that people, it's sort of like, I always worry about it, because if you don't really know what you're doing, or if you're not really careful, you don't understand how it can gap. And in 4 days where the market's essentially closed, and let's face it, Thursday it's basically closed unless something massive happens overnight. The reality is a lot can happen. And this particular holiday, in a world where the demonstrations that are going on are basically against this holiday, has the potential for all sorts of things to happen that could be both good and bad. And so, yeah, I hear what Josh is saying, and I kind of feel exactly the same way. That's why I was nodding my head. It's like, it doesn't feel like volatility is going to drop below the mid-20s anytime soon, considering everything that's out there. So, you have to do your risk reward on your own.
This is Jeremy, CEO of CoinGenius. I would absolutely agree. We're doing a lot with the VIX. I was trying to pull up some correlation studies that we've done recently. There's what we define for, somebody who's maybe new to crypto, or you're new to trading, something called market regimes. And a market regime is really defined as the way in which somebody is trading at a given time, given a certain set of criteria. So if there's a tremendous amount of fear or uncertainty, they're going to trade a specific way, maybe stay more liquid as an example, versus being more aggressive. Obviously, all of this depends on your level of risk and your time horizon as an investor. But overall, what we're seeing in some of our correlations and what we've seen lately is there was an anti-correlation with the VIX and Bitcoin specifically. So that's a specific market regime that we're in that's working now. And we noticed it's about 3 days ago now that the VIX went up by about 7%. And conversely, crypto and Bitcoin went down between 5 and 7% with about a 2-hour lag behind that. So that's not necessarily going to happen time and time again, over and over. This is just the regime we happen to be in. But we also saw that as soon as we saw COVID come into the picture, and we saw a lot of fear and uncertainty globally as it moved from China to Italy. And then our team was analyzing all the flight records and flight data and anticipated it hitting New York very hard, and it did. And as soon as it came to the US and started spreading, we saw fear driving the economy, and we saw a tremendous drop, 1,000-point plus drops in the Dow, almost on a daily basis, and futures kept having to get shut down. In that type of regime where it's driven by fear, and you see things like, VIX, over 40, 50, everything will go down together. And we're anticipating, or at least I'm anticipating, this is not financial advice yet again, there's a lot going on in the global macro economy. COVID is on the rise. US is not doing very good in containing it. People are assuming that it's not so bad because the death rate is not rising. Well, guess what? There's a 2, 3, maybe even 4-week lag in terms of seeing those numbers in terms of the actual death rate in conjunction with the spikes. The first spike that I believe Oz and some of the folks on our team predicted would happen would be from Memorial Day, and people going back to the beaches and all, hanging out together without masks. And sure enough, 2 to 3 weeks later, as predicted, we saw a spike. I don't even think we've seen the spike yet from the protests and all the things, and the organized gatherings with people that were not wearing masks as well. So I don't see this getting any better. I think the VIX is, to your guys' point, not going down anytime soon. I think it's only going to rise. And depending on how it rises, and we're going to continue with our data science team to analyze this, if it continues down this path, then you can see Bitcoin moving the opposite way. So with that said, that's where I'm at.
Yeah, it was interesting too was Binance Research's finding the correlations in between Bitcoin and the S&P for the first quarter of this year, and then the decoupling and looking where VIX is right now. It's also interesting to see where gold has gone. And here's kind of some initial predictions I'm just going to throw out there based upon some of the risk, as well as, things that we've talked about over the past couple of weeks. One is the commodities market is probably going to start going wild because we've had supply chain disruptions. And what we're seeing across the country is, first we saw the Memorial Day spike. Now what we're starting to see is what I would call the protests, the riot, and, even the, I'd call it gatherings and campaign event spikes that are coming up. And there's many of them. And the question I think a lot of people have to ask themselves is, is this, are we actually in the second wave or are we in the first wave? And I think we're still in the first wave. But commodities are going to become relatively volatile. The logistics around these systems are going to have challenges because right now you go into a lot of grocery stores. I mean, I think if you're in an Erewhon or Whole Foods or something higher end, yeah, they're full because they're charging quite a high market fare. But if you look at most of the supermarkets like your Giant Eagles, your Foodlands, your Food Towns, those types of things across the country, what you're finding is for a lot of goods, yeah, it looks full in the front, but you pull 2 cans and it's empty behind there. And the challenges are going to become multifold. The cost of goods is also going up increasingly over time. The price of milk is up, the price of meat is up, the price of chicken is up, the price of canned goods is up, the price of fresh vegetables is up. So these are all going to have cascading impacts inside of the market. And then lastly, I would say from the trading perspective, just looking at the negative correlations of VIX, I think some of the stuff that we've talked about earlier this year is that Bitcoin and a number of altcoins may become the safe harbor, because in the near term, once, I'd say probably starting mid-July, we're going to start seeing a bit of a dollar consolidation. And that's because people are going to start moving money out of riskier assets. The RMB, risky. Why? Because they keep playing, next door neighbor smack 'em with India over the line of demarcation. On the flip side of that, you've got the euro, where the euro's moved into, kind of stable operations versus COVID. But to what Jeremy's point was, if you look at the flight patterns and what things hit, I mean, we had about 5 strains of COVID hit in New York City all at once, coming from multiple parts of the world. And that, I think, has had, the catastrophic result we've seen in New York. The quarantining has stopped things, but we've got asymmetrical quarantining. We've got asymmetrical mask utilization across the United States. So what we're going to see is asymmetrical growth of the COVID phenomena and the pandemic deaths, I think, over the next couple of months. The mortality issues and the utilization of appropriate therapies, I think, is also going to be something that we have to factor into this as well. My current understanding in talking to a number of doctors is that the way that they have been treating this with respirators may not be the right way to treat this, that the sickness itself manifests itself more like high altitude sickness in the body. So it's more something barometric in terms of compression, like an iron lung might be more helpful than what they're trying to do with these respirators. But again, there's a lot to be learned about this disease because there's not a lot of knowledge. Yet on the flip side of this, the Gates Foundation is testing out, vaccines in Africa where there's no financial recourse for people who may have issues stemming from that later. The cascading impacts of COVID is the last thing I want to talk about. Most of the people who've suffered COVID and gone through the respirators have a significantly increased mortality rate or mortality risk over the next 5 years. And so what a lot of folks are postulating, at least in the medical community, and this is from some of the work I'm doing with Radiologics and, some conversations that we continue to have inside of the medical environment around blockchain and where this stuff is that there's going to be significant die-offs from this. And so the economic impacts, the social impacts, the familial impacts, the societal impacts from these things are yet to be felt. And we're not even the second wave of this pandemic yet. So near term, this is going to sound callous, but, from a financial perspective, I think there's ETFs that look reasonable. Cryptos look reasonable. Commodities are something you should be looking at. From a longer term perspective, you need to be, not to say that you should bunker up, but you should be hunkering down a little bit and at least starting to look at what disruptions are in the supply chains around you so that we can start figuring out, how people are going to maintain and abide, because there are scarcity issues that are coming. They may be inside of the 6-month horizon, but these are all challenges that we need to think about. And then the landscape of COVID, the landscape of treatment, and a variety of the data points coming from that, those are things that we really need to start keeping more of an eye on, because those bumps, those bubbles, are going to have cascading impacts, not just to markets, but to consumer perceptions and to basically the ability of people to purchase.
Yep, I would agree. And I see a lot of folks nodding here. Morgan Steckler, I'd like to pick on you and talk about commodities, especially as we're getting scarce in the next 6 months. What does that mean to you in terms of anticipated market behavior?
Well, thank you. I do actually, I would like to say I totally agree with Oz. And I personally think that we're still in the wave one, part one. And I do think that with the protesting and with a lot of these people not wearing masks, we're just showing an embarrassment of how the U.S. has reacted to this. And it's going to set us back probably at least through the end of the year, if not longer. In terms of hunkering down, a lot of that does pertain to commodities. I personally have never received so many calls daily as I've been in the precious metals industry for over 20 years on supply and questions of people trying to procure physical metals, whether it's for their IRA or just to have outside of the dollar. The supplies are beyond shrunk down. It has not helped that it was discovered in the last number of days that China discovered 4 tons of gold to be fake. Bars in which they borrowed $4 billion or so, I believe, against it. Or it's not $4 billion or $4 trillion, some astronomical number, which also just shows some of the games I believe governments can play, and they were found out, which also goes back to the supply of real coins as opposed to bars. Bars are very counterfeitable, and as you can see, it's very easy to plate one, and if you don't know what you're looking for, or if they're in a huge supply like that and not looked at and verified, lots of games can be played. Coins that are made by governments cannot be counterfeited. They have a lot of built-in securities and the reliability, but you can see the wait time on some of these. The premiums have shot astronomically through the roof. That's why gold hit over 1,800 recently, the highest it's been since 2011. The ratios are still about 100 to 1 of gold to silver. Silver and gold are huge demand right now, but if one's trying to buy physical, unless you know where to go, you're going to have to wait anywhere from 4 to 12 weeks for delivery, which is also something that a lot of people feel uncomfortable with. They want to convert, their crypto or their gold immediately into, or cash into something they can hold and put away. It is grown exponentially, I would say. I think the demand is just shooting up as people are worried, and the continued helicopter drop of this fiat shows the fragility of fiat in general and why people, not financial advice, should be in crypto and gold, something they can physically, tangibly be in control of, where they can quote be their own bank. So that's why I've been a little MIA. I'm literally getting bombarded daily on people, trying to find solutions for that.
Hey, Morgan Steckler, how's it going
Hey.
out there in the Aurora Borealis? I see.
It's beautiful. It's beautiful. Let me tell you, it's been, and we've been hunkered down. I'm just making sure my family's taken care of. Oz did mention supply chain issues on food and stuff. I'm not personally going to a gym. Bought an elliptical, have my gym here, and I stocked up on canned goods and food, and bought a deep freezer because I don't want to go outside. Who knows what these long-term effects are, especially on infants and babies. So you stay locked in. You stay making sure you have some cash on hand, but make sure you can have the assets that are not going to depreciate and never go to zero, which goes back to what the real form of money is. Yeah.
Hey, Morgan, I have a question for you. You mentioned something that's near and dear to my heart as a stat arb guy, and I know it's a long-term horizon, but the gold-silver ratio to me is one of the most interesting things. I'm curious what your thought process is, because I'll be blunt. Obviously, when there's a huge demand for liquidity, gold massively outperforms silver, which one would think that you're saying is going to go on for a while. That said, there just isn't that much of it. And there's been plenty of times in the history of the world, particularly if you go back, if you go back in China, it was predominantly silver, etc. It's a lot easier to get it. I personally have a fair amount of physical silver on hand, mostly because I'm a complete nut, my wife would say, but we have a safe with silver in it, right?
We do too.
So, okay,
I do too.
I'm with fellows there. That's good. But I'm curious because, if you look at the ratio of silver to gold in the crust of the earth, and for the longest time it was 15-1, based on more or less that. We moved in the various liquidity issues ever since the Hunt brothers popped to 70 or so, and then recently meaning the last several years, up to 100 and beyond. I'm curious what you think about that when all this stuff normalizes. I mean, part of me thinks that if there is an actual currency crisis, that ratio will start mean reverting, but only after the liquidity side effects, go off. But I'm curious, as you're closer to it than I am.
A good question. And yeah, I've been dealing with quote doomsdayers for many years, and whether it's emergency food, things like that. But historically, the ratio has always been 10 or 12 to 1 over the course of time. This ratio has gone out of control. The rarity of silver is far more perceptive to people who dig in than people realize. It's used for a lot of functionality, for its reflective purposes, for its ability to be in batteries and cameras. And the supplies, both for gold and silver, the ETFs are always scary because they're just contracts that are compounded exponentially upon one another, and you're just with paper as opposed to the physical. So that game is controlled by the big players, whether you need 10 million or above in order to actually control that chessboard that they change anytime on you. The ratios I do personally see go down. The all-time highs of gold we're close to. The all-time highs of silver were 60 to 80% off of. The one caveat to that is silver is a lot bulkier. Having 10,000 worth of silver, that would be hard to carry on your backpack. In gold, it's a lot easier to carry. In crypto, it's super easy to carry. So it's showing the future of money. But when push comes to shove and the mass adoption of cryptocurrency still is taking time, and we're seeing huge leaps coming forward, it would be a lot easier to carry in talking in terms of, I guess, fiat. Silver is your $1, $5 and $10, where gold is $50, $100 bills. So it's easier to carry smaller denominations and ounces of silver, because you can potentially find sources to trade in a community or some smaller shop to be able to buy your meat, your milk, your bread, et cetera. So that has always been a haven. One just has to think of the physical shortcomings of it. But I personally I've always seen silver should be much higher than where it is at around 18 or so. Gold should not be lower than palladium, in my opinion. Platinum always was double the amount of gold until the last number of years. It's very interesting how undervalued platinum is. There is a demand, but that's so much rarer in terms of the coin denominations and bars, which you avoid. People always like coins just because of the tax exemptions and the 1099 exemptions that occur with coins made by governments, which is what has also led to this huge supply gap, especially due to COVID and a lot of the productions being shut down.
So Morgan, I'd like to pivot the conversation a bit. I know that we've spent a lot of time on precious metals and coins and like that economy, right? Like you understand that economy very well, and you understand how it ties into the global economic engine. I'd like to take it down to layman terms, and I'm kind of just thinking everyone who has a 401k right now, the boomers that are retired, like my parents, that they looked at things like small caps and large caps, and that they had some level of vernacular for diversifying their 401ks. I think it's important to kind of explain to the audience what is going on in the global economic engine right now beyond the printing of $7 trillion. We also have things that are happening in real estate. Yes, Steve Kwan, I'm going to turn it over to everyone. I'm just going to frame the question and let you guys have a field day with this one. So there's small cap, large cap, there's real estate, there is the layers of debt and the games that folks play with that, of hiding folks, hiding things in baskets. There's the which we're in danger for the last 2 years. There is this over engineering of how we got here. We all on this call, we know it's coming down. That's why we're talking about potentially exchanging silver for meat and bread, because we understand that that's what it could come to. And we're not like extremists here. That's just the writing on the wall. So to the team, to everyone here on the roundtable, let's talk about what this means to the average person of being literate in today's day and age of what to expect over the next 6 months and how they can protect themselves.
I'd like to start first on that, if you don't mind, Christina. I think that sometimes here, especially, I would put us in the fortunate class that we're able to talk about, well, gosh, I wish I had more Bitcoin than gold, or I had some platinum, but I should have had silver, or why wasn't I in crude? Like, no, I mean this seriously. Like, these are fortunate problems to have where a lot of people are just having the question, wow, how can I pay for gas? Or wow, how can I do this? I'll tell you another item that's seems extremely sold out, at least in the Chicago and tri-state area of the Midwest, is many of the most common firearms and firearm shells are essentially sold out and have that wait listing period too, or I'm not saying that means something, I'm simply making a statement. But I think first and foremost is with the real estate story, Christina, that's actually probably one of the more scarier situations where you've had people and businesses being able to push the proverbial can down the road, where according to, and double check me on this, but according to government standards, if you show an accounts receivable, which basically says, the person says, yes, I'll pay you my mortgage at a later date, then their books are clear. Whereas if they don't have that person saying anything, then their books are not clear. So I'm not sure how many IOUs I would actually trust people for in this environment, but I think that real estate in the next, 3 to 6 months is going to have some, I guess, shape-shifting moments where it's not a bad idea, at least in our house, to have some capital preservation methods where you're not looking to make, you're not looking to lose, you're just looking to have something available in the future if things were to crater, whatever asset that is you're looking at. But I think that in real estate and leveraged debt, those are two of the most prolific areas which we think could essentially see some sort of sharp move down in a very limited period of time. And I think real estate's also harder to gauge because people aren't selling as much here in Chicago, nor are people buying. So you're not seeing a lot of changes. But when that proverbial shit hits the fan and you see a bunch of people try to sell at once or a bunch of people try to buy at once, I think the price resets.
Yeah,
I think I'm sorry.
The rental market metrics there too, but I'd like to give it to everyone, and let's try and keep our responses to like 2 minutes so we can kind of ping pong off each other. But I totally agree, Steve. I can't wait to hear everyone's feedback here.
I'll just say quickly, I think that with this unique situation, I think that we're still in this wave one, wave two hasn't hit. U.S. has completely crapped the bed on the response, and I think, you could see just from the circles we all probably swim in, a lot of people are leaving urban towns, urban cities, whether that's the right response or not. You're seeing office buildings starting to get gutted. You're going to see offices not be occupied anymore. The work from home is going to be the new norm, at least for maybe the next year or two. Who knows? Let's not even talk about sporting events and places with crowds. As a result, places like Silicon Valley, San Francisco, Los Angeles, you're going to start, and all the urban cities, you're going to start seeing a huge amount of real estate that, if you have the capital, if you're among the blessed few, which, I would suspect a lot of us are, we're very blessed, that if you have the capital and you have the means, whether you use crypto or gold or use cash, you might be able to pounce on, this real estate at, 10 cents on the dollar, who knows? But real estate, there's only so much. It's always been, it's a rare commodity because there's only so much. You can't create a new island unless, the earth decides to shift and another continent forms. So there's only so much real estate. There's only so much land. Having multi-unit complexes or places that pay rent, if people can afford it, that's going to be a huge arena. But it's completely unknown. I would say those ones, people, not financial advice, but people taking risks, the real estate could probably be, pretty cheap right now, in my opinion.
I think the biggest change is, and it's pretty obvious, but for some reason it just takes a long time to penetrate people's thing, isn't an absolute real estate up or down. It's a real estate dispersion. The fact is that New York, which is now I'm right now 100 miles south of New York in a beach town. I had a beach house that I owned. This is now my permanent residence. It's actually quite awesome. The reality is that if you look at New York City, the cost per square foot was somewhere in the neighborhood of 4 to 5x what it cost them to build it, more or less. If you look at other cities, and if you look at the bottom in 2007, 8, there are a lot of places that went down to under the cost of building. There is no way that cities like New York and, dare I say, Chicago or Boston are going to be able to maintain a premium on price per square foot well in excess of what it costs to build in a world where people can work from home, in a world where people can do what we're doing right now. If you think about the difference, people, no one changed their physical meeting schedules in all the big companies, and I work for multiple big banks. They didn't really change, even as video conferencing improved. Guess what? Every big bank and every big integrated global firm now knows that you can get a lot done on video conferences. And that is a massive change, and people have not taken it into account. And yeah, they'll say, well, that's going to hurt the airlines. Maybe, but I'm talking about something much more fundamental. Why does everyone need to be in physical proximity to one another for the odd meeting that you have to have? And that is a massive change. And so I would expect to see urban commercial real estate and therefore urban real estate to normalize. The ratio, I'll end with this. The ratio that I love to track, and it's not really all that scientific, is the ratio of a suburban 5-bedroom home. A suburban 5-bedroom home in New Jersey used to buy you about a 3-bedroom condo in a decent building in New York. Last year, that it was to a 1-bedroom condo. There is no way in God's green earth that we don't go back down to a 3 or maybe even to a 4-bedroom condo sort of thing, where the 5-bedroom house is actually more desirable because you have land, et cetera, et cetera. And that's only assuming, and I'm just assuming that this goes on for another year or so with COVID. I'm talking about long-term trends where you don't need to be in those physical buildings anymore. That's a big deal.
If you
just to, sorry, Christina.
Yep, and I want to hear from JP after this. So Oz, we'll hear from you real quick, and then we're going to pivot to JP.
Yeah, Mark, where are you, down in Asbury?
Oh, me? I'm in Long Beach Island.
Okay, I'm sitting in Red Bank right now.
Oh, that's funny.
All my mechanic, and I'm up in New York, but my mechanic and everyone else and some family are down here. So I just popped out for the day. But yeah, it's interesting. I'm going to go back to 1988, okay, and the New York Times article that stipulated that this was about the first $1 million condo coming into New York. And I think we're looking at 3 different scenarios that are potentially happening. I'm going to tell you why. Because I live in Harlem. I'm running for state senate in Harlem. I'm a district leader in Harlem. I'm a state committee person in Harlem. And I've been invested in the community for 7 years. The average price of a 1-bedroom was typically between $300 to $650 up there, right? And that's outsized because the rental market for that 10 years ago was $800. Those 1-bedrooms are now around $2,000, a little bit over a hair over $2,000. And if you have a nicer one, it's a hair over $3,000. The challenge that I have is that New Yorkers' incomes have not increased. The AMI, the average median income, which is a statistic that if you don't know it, everyone should know it, is how they justify how they do tax levies, as well as allocations of spending and funding into local neighborhoods. And if you think about things like defund the police and all of this other stuff that's coming out, those funding discussions directly impact neighborhoods like mine, okay? Because the services that are first to go are the police athletic leagues, the community policing, and all the touch points with the community. And so why am I talking about this in this conversation? I'm talking about this in this conversation because I have seen that average price drop into the 300s from 3 to 6. Okay, so it's like the lowest price one bedrooms I've seen in my area are about 170. The highest, the highest, they go high because we've got a bunch of gentrification building coming in. But some of that building has stopped. Okay, there's there's probably 14, 20-story buildings that you can see that the construction has halted. And so the question was, one, what becomes with this kind of stuff? Two, I think your utility case is a modern utility case in terms of the five bedroom.
Can you wrap up the?
Yeah, can you hear me?
Yeah, you're cutting out a bit.
Oh, can you hear me now?
Yes.
Okay, so the utility case of the 5-bedroom, I think, is a good one. If it buys a 3-bedroom in New York, I think that was fair up until recently. But I think what we may be looking at, and this is why I go back to the 88 reference, is in the late 80s to the 90s, they were giving brownstones away. Okay, and one of the problems that we've had in New York, mostly in what you would call urban communities, which are black and brown communities, is that people are having trouble keeping up with the taxes on these things. We also have, we've got folks like de Blasio that, have basically changed the law so that if one of your payments to the city's late, it's an 18% hit. So this is going to affect older citizens that might be 5 days late, and all of a sudden there's an 18% hit on any payment that they had to make to the city for something small. And, the tax levies aren't huge, but there's a 2% tax levy that's increasing inside of New York, inside of all of this. So what does this mean? The housing prices are going to collapse. The market for housing is going to open. The lack of policing or the deltas to policing are going to increase crime so that we go back to like the Dinkins era. And
okay, Oz, we gotta take it back to like market analysis.
No,
now.
This goes to the market analysis piece. The average price of your real estate is going to drop dramatically, and the average price of your corporate real estate is going to drop dramatically. To echo what Mark was saying, half of Midtown might not come back. So what are you going to do when you have millions and millions of square feet that were at $50 a pop that now no one's renting because they're just letting their leases expire? And we're saying the same cascading impact inside of San Francisco, where a lot of people are going virtual. And then we're also seeing these migratory patterns where people have talked about 500,000 people have already moved out in New York. And we're expecting up to 15 to 20% to continue to do that. The flight from cities will continue. The question really becomes one of the evaluation of corporate property and the evaluation of residential property inside of this, and how that's going to impact everything from real estate trusts to bank portfolios to mortgage portfolios, because if the value of all of this stuff collapses, the secondary impact is going to be the collapse of the stock prices of those banks.
That's exactly where I want to head with this. So I'm going to open this up to Joff, right? So Joff, in your experience in being a crypto trader, obviously everybody who's listening to this wants to know what's happening with crypto and Bitcoin and all those things, and how all these things interrelate with one another. So how do you see this playing out in terms of all the things we've talked about, including with the real estate bubble and the devaluation of all of these assets across the board?
That's a mouthful. Well, first and foremost, let me commend everyone on their analogy and where they're coming from, because I agree with every one of you guys, really. But what you haven't done, or what we haven't spoke about, is what about not in the United States? You guys live in your world in the United States. I don't live in the United States. And so I live in a whole nother country outside the United States. And there's a lot of us out here that we're looking into the United States, and we're on the outside looking into you guys to see what your next move is, to see what's going on over there. And then we base our decisions on that. The U.S. has always been a leader, and I think it still is. And I think it still has a lot going for it, non-manufacturing wise, but IT and trading and all the wonderful things that are going on inside the United States. So as far as the housing and real estate, I see this worldwide collapse. I don't see it just in the United States. I see it coming outside the United States for multiple countries, not all, but multiple countries. You look in Europe and you look at the evaluation of real estate there. You look into, the Latin American countries or Latino countries, and see that the real estate there is tremendously high. And, you know, you look in, say, like Panama, and in Panama, you know, a 5-bedroom, nice 5-bedroom condo, it runs anywhere from $700 to $1 million. And so, you know, and the rent on those are upwards from $5,000 to $8,000. And it is coming down, of course, because of the pandemic that's going on around the world. But that's, you know, one thing. And then, you know, there's some good news, I think, for crypto. I think, you know, Morgan, you touched on something really good. I think good news on as far as in the crypto space is that, you know, you can't carry gold, you can't carry silver. I do suggest, for me and my family, I'm not telling you what to do. I'm not a financial advisor. I'm not licensed to do so, but I will say this much. I will buy gold and silver because I want to use that later on if I have to. But I can't carry it. I can't carry it on my back. I can't carry it in my backpack. I can't load it into my car and go to other places with it. If I want to go and exchange a little bit of gold for gasoline, what do? Do I shave a little bit off? So I do believe that cryptocurrency will be something that will be used mass adoptedly wise in the near future. I think that we have a lot of good things going. The gold was one of those things that was $2 billion, 78 tons of gold was forged, basically. They had gold layer, they had plated the bars with zinc and copper bars and gave it to the bank. They defaulted, a mining company defaulted on their loan and gave the company 78 tons of gold, or 780 tons of gold, $2 billion worth of gold that was fake. And so, you know, that right there would tell you, if you had digital assets, you know, maybe that'll push that a little more. And then if you look at what's going on in Europe, you know, the ETP just listed on one of the 3rd largest exchanges in Europe. So, you know, we're looking at some really good opportunity for those of us that are sitting well. I would suggest for my family and for me, what I would do is I would accumulate, and then just wait and sit and see what's going to happen. You know, you think about it around the world, all these businesses that aren't going to come back. You know, there's a lot of these mom and pop companies, and, you know, it almost feels like the big daddies all wanted to flush us out, that, you know, that if we own any small businesses around the world, and they're shutting them down, and they're not going to come back. So all this real estate is going to be empty, but you need to think of where's that's going to go. What is that going to do? I mean, think about this. If you have a grocery store that shut down, a little mom and pop, like a AMPM or something, a convenience store that doesn't sell gas, they just shut down and they're gone now, or a furniture store, or all this vacant property, what are you going to do with it? Okay, now it's vacant. Are you going to put a new furniture store in, or are we going to go back to the way it was? So you really have to sit back and just see how this is going to play out. I think that's your smartest move, to accumulate what you can and just sit back and let this play out. Be safe, bunker down. As Morgan says, you know, I have 8 children and I have a little 22-month-old, and we're bunkering down, brother. We're going to sit down and we're going to wait and play this thing out and let it play out and see where it goes. And I think that's the smartest thing that you can do, is try to accumulate some gold, some silver. You know, again, it's not financial advice. Make sure you're liquid in the Bitcoin world, and of course have a little fiat, you know, that for emergency cases. You know, I'm.
So JP, we have to wrap up here pretty quickly. We only have about 4 minutes left. Thank you so much.
I was just actually going to say one more thing on that. I agree everything with. I was just going to say something very quickly in terms of, you know, precious metals. There, back when I used to work with Robert Kiyosaki, he when I was working with Mike Maloney and the Guide to Investing in Gold and Silver, I ran their sales force. They were all about 24-karat jewelry. It was also something that was wearable, portable, that you didn't have to take off going through airports, and easily convertible. There are also things called Valcambi bars, that are bars that look like credit cards that can fit into a wallet, that are broken apart. At the end of the day, you have to know who to talk to and who to trust. Trusted sources are important, especially as you can see these counterfeitings that go on. I've seen them when I worked OTC, and I saw bars that were cut open, and the technology's gotten worse. So you have to trust who you're talking to. You have to work with the proper people, and you have to get the proper product, so you know you're not overpaying. If you're doing that, also you're doing something right. But again, yeah, it's easier to carry you can carry a few $1,000s worth of silver or gold, but it goes back to the ease of use. You can carry all the crypto ever created, every crypto on your phone, literally. So it shows one of the real new forms. I'll leave it there.
You know, Christina, one last thing I want to talk about, just to remember, guys, two moves were big whales. They just moved, a whale just moved a lot of Bitcoin. If you guys saw that, with very minimal, it was moved into 2 different wallets, minimal transaction fees. I think 27 or 26,000 Bitcoin was moved for like $1.56. So, you know, keep in mind, Bitcoin is the way. I think it is anyway. And cryptocurrency, diversify your portfolio.
And
That's
if you
all.
guys want to see the whale movements and the large wallet movements happening, go on Telegram. CoinGenius has the real-time updates. It's at CoinGenius Stats. Please follow that. You'll get all the most up-to-date information there.
Awesome. And Mr. Josh Lawler, last thoughts, and then Dave, last thoughts, and we have to wrap it up for today.
Fair enough. And finally, the leaf blower is no longer behind me. So on the gold and silver piece of it, the only thing I would want everybody to kind of understand, there are cryptocurrencies out there that are backed by these assets, and there are a lot of scams of cryptocurrencies out there that claim to be backed by these assets. You know, it's really important to do your investigation to make sure that if you're getting something that's backed by assets in a vault, not backed by assets in the ground that are going to be mined with the money that you're putting in to buy them. And also that, you know, it's something where it's been verified, dare I say, in the US, possibly in some other kind of developed countries, but we've seen a lot of different kind of people trying to monetize natural resources that they may not even really own. You're on mute, Christina.
Yep. So
I agree.
My final thought
with you.
is I come back to what JP was just saying. The word trust is exceedingly important when one understands why people like me are bullish on Bitcoin and crypto in general. Yet, yeah, there's a lot of scams in crypto, and I'm not going to say that, you know, Compound and some of the DeFi things that have gone crazy are scams. I'm not saying that at all. I'm saying there will be scams around the periphery, and people will jump into it, and you'll see a mini repeat of 2017 over the next year, in my opinion. And that's the way things work. Greed, cycles of greed and fear. We just came out of fear. We're going to get back into greed. But that greed is what's likely to drive the next bull market, because all of a sudden we have a asset that people under the age of 30, 35 don't have an intrinsic issue with, and they understand that it means they can trust that their buying, their selling is working, because that's exactly what the Bitcoin blockchain does. And so I think it's really important to keep that at the top of one's mind. I think we right now, we feel like if you think about what happened in 2017, it feels a lot like 2017 right now in certain metrics. I'm not saying we're going to have an ICO boom or things are going to go crazy at the end of the year. Not that at all. But if you remember what happened in the summer of 17, there was the whole issue with China and everything that went on. You saw repeated, it looked like, chart attempts to knock Bitcoin down, and they failed. And when they finally gave up and when it finally ended, a very serious bull run happened. Now, I am not suggesting that we're going to go up by a factor of 5 or 6 again. We might, but I'm not saying it's certain. But I am saying that it's highly likely that we're looking at that, you know, especially given the macro scenario. But that trust is a very important piece of information.
Yeah.
Awesome.
Last thought there on trust. You know, look at who has been from the ICO phase.
Guys, we
I could just say one thought.
Discord. We have to wrap up. Sorry, I need the bridge. All right. Thanks, everybody. We'll talk to you guys soon.
We have too much.
Bye.
Too much to say. Sorry.
Bye. Thank you all very much.